class. This is now a continuation of Chapter 3. In this video, we're going to look at the schedule of cost of goods manufactured and the cost of goods sold. So we're going to see what those two are made up of and how we can get to those figures. So the schedules that we're talking about, they contain three kinds of costs. Okay, so three kinds of costs. These three kinds of costs are direct materials, direct labor, and manufacturing overhead. Okay, so that is what we remember from chapters 1 and 2. Remember, those are essentially your manufacturing costs. All right, so those are the three kinds of costs that we'll be working with when I'm calculating these two figures. So these schedules that we're going to be looking at, they're going to calculate the cost of raw material and direct labor used in production and the amount of manufacturing overhead applied to production. And then we're also going to use them to calculate the manufacturing costs associated with goods that we finished during that specific period. Okay, so we're first, because these are really still product cost flows that we're going to be looking at. So I'm going to try and make this as clear as possible. I find this a little bit better than just staring at PowerPoint slides while I'm talking. So let's hope this is clear. All right, so the first thing that we want to look at is raw materials. This raw materials account. When we buy extra raw materials, they're added to whatever the beginning balance was in that account. Okay, so that's raw materials that we have available to use in production. So as an example, let's take a look here. I'll have beginning raw materials, right? Whatever, this would be the cost of the materials that I started the period with. Okay, so whatever I started with in my raw materials account, any extra raw materials I buy will be added to that. So we'll add raw materials purchased. All right, so then what do you end up with when you add the newly purchased raw materials to what you had left at the end of the last period, right? What you started this period with? Well, my beginning raw materials plus the additional raw materials purchased must mean, okay, that's the raw materials that I had available to use, right? Raw materials available for use in production. Available for use in production. And that makes sense, right? What I started with plus what I bought in addition to what I started with must mean, okay, that's the raw materials that I have available to use on these jobs throughout the period. But as the period goes on, we end up using raw materials, right? So now when I go and look and see what I have left, I can use that number to figure out what was exactly used, right? If I have my raw materials available for use, if I subtract my ending raw materials balance from that number, then I'm left with the raw materials used in production, whatever I used for that period. Raw materials used. Okay, so to recap, my beginning raw materials plus what I buy is what I have available to use that period. And then whatever I have available minus what's left after the period is over must be what I used. And these raw materials used, that is what we refer to as direct materials. And any indirect materials would be part of manufacturing overhead. So this raw materials used becomes part of manufacturing cost. Because that raw materials used is now either considered direct materials or indirect labor, or sorry, direct materials or indirect materials, both of which make up part of our total manufacturing cost. So to recap what we know about manufacturing cost. If we want to do a little schedule for that one. Remember, that's made up of direct materials, so the raw materials used in production that are directly traceable. Direct labor, manufacturing overhead, which is indirect materials, indirect labor, and any other manufacturing overhead elements. So when we add all of these together, that's just total manufacturing cost. Okay, so that's what that looks like. And really for this plus and minus for raw materials, you're really just trying to visualize that T account, right? We have the beginning amount here. Any purchases are debited to that account. And anytime we use raw materials, they're credited, and that leaves us with an ending balance. So that's the overview there for raw materials and then just manufacturing cost in general. Now, when we're talking about manufacturing cost, the direct materials, direct labor, manufacturing overhead, remember that is going to be added in or moved to work in process. Because as we work on a job and we incur direct materials costs, we incur direct labor costs, and we apply manufacturing overhead, all of that is moved to work in process. So total manufacturing overhead cost, that is always going to be added to work in process, right? As we saw with the journal entries that we looked at earlier for this chapter. So I'm going to, here on the right, do that schedule for work in process to make that a little bit clearer. Let's go ahead and highlight that to make it a little bit more clear here. Okay. I'm going to zoom out of that just slightly. There we go. So that way we can look at this all at once. So the work in process account, you most likely are going to start that that period with some balance in work in process, or you can start it off with nothing if it's a new period, right? Or a new company, sorry, or if you just completed everything last period. So the beginning work in process can be 0, or it could actually have a number attached to it. But we start with our beginning work in process, right? Whatever we started with, and what increases this account balance? The total manufacturing cost for the period, right? Any direct materials, direct labor, overhead costs that we incurred for the period. So work in process is increased by the total manufacturing costs for the period. So I'll put total. So whatever work in process I started with, plus any additional manufacturing costs I added for the period, leaves me with my total work in process for the period. Okay. Now, that would be just the beginning plus the costs added in. Again, we're trying to visualize this as a T account. So remember the beginning, so the work in process, we add direct materials and here direct labor and applied overhead gets added into this account, right? That's total manufacturing costs. But then we end the period with some balance in this account, right? And what causes this account balance to fall? Because remember, it's an in-process account, so as soon as I finish a job, the cost of that job is moved out of the work in process account into finished goods. So if I take my ending balance here, my ending work in process, and I subtract that from the total work in process for the period, that difference must refer to the cost of goods manufactured, right? Or remember we said the cost of goods manufactured is the total cost of the work completed for the period. Okay, and the cost of goods manufactured is just essentially the costs moved to finished goods because you finished them. Okay, we can see how that now, we can scroll down just a little bit and see how that now further connects with finished goods. So that we did first, second, third. Go ahead and scroll down here. Then finished goods next. Because remember we said cost of goods manufactured is the amount that work in process decreases by for a period, right? The amount of costs that flow out of work in process because you finish jobs and into finished goods. So finished goods, what does that schedule look like? Well, you have your beginning balance, getting finished goods. And then what makes this account increase? Remember we said cost of goods manufactured, right? That's the cost of the jobs finished. So we add cost of goods manufactured. So if I take my beginning finished goods balance, what I had available for sale, plus now the cost of the newly finished items, if I combine those two, that must mean that refers to the cost of goods available for sale. And same thing with the finished goods. I have my beginning balance and then cost of goods manufactured added in as a debit, right? But then when we look at what's left, what's going to cause that finished goods to fall? We'd have to sell units, right? And for every unit that is sold and moved out of finished goods, where does it go? It goes to cost of goods sold on the income statement. So if you look at your cost of goods available for sale, everything you had available for sale, and you subtract out your ending finished goods balance, that difference then mathematically has to be cost of goods sold. And that cost of goods sold then is what, as I said, we will see on the income statement. All right, so let's now use what we just talked about to do some examples. So, and these I'm pulling from the PowerPoint, so you can refer back to these as well. So let's take a look at our quick check number 1. It says beginning raw materials inventory was $32,000. During the month, $276,000 of raw materials was purchased. A count at the end of the month revealed that $28,000 of raw materials was still present. So I'll call that my ending balance. Okay? At end of month, or end of the period. So the question is, what is the cost of the direct materials used? All right, so let's see if we can use a T count here. So it says that the beginning raw materials inventory was $32,000, so that means it had a debit balance of $32,000. But then it says we purchased $276,000 worth of raw materials during the month. Where do raw materials purchases go? How do we journalize that? Recall from the first video, you debit raw materials and you credit accounts payable or cash. So this purchase of raw materials, if I buy more raw materials, this account balance must go up with a debit. Right? And if I add the 276 and the 32, that would be my raw materials available for production. So if we go ahead, we add that, we have 32,000 plus the 276 gives us $308,000. So we have $308,000 of raw materials available for us to use in production. But then they said they counted, right? And they saw that at the end of the period, they were left with $28,000 worth of raw materials in that account. So they're asking us what's the cost of direct materials used, or just materials used in general. Because remember, what did we say causes this account to fall from, in this case, 308 to 28? That for that to happen, raw materials are being used. So the 308,000, I believe that was the number, yeah. That was our raw materials available for the period overall, based on what we had started with and what we bought additionally. We had $308,000 of raw materials available, but but then we ended the period with 28,000 of raw materials. So how much raw materials did we use? How much did that account fall for us to go from 308 to 28? We just have to do a subtraction there, right? 308,000 minus 28,000 is $280,000 raw materials. So this account must have been credited for $280,000 throughout the period to leave us with an ending balance of $28,000. And we can write this out just like we did explaining the product flows not too long ago. You can also write it out as follows. Beginning raw materials. In this case, it was 32, and this is if we don't use the T account, right? Plus raw materials purchased. That was 276. We add those together, remember, and that's the $308,000. That was the raw materials available for use. And then remember, the next step is to subtract out ending raw materials of 28 in this situation. And that leaves us with the 280,000 of raw materials used. Okay, so this is the way that we actually should be writing it out, but then visually and journal entry wise, that's what it would look like within the entry. On to our next example. Next one says direct materials used in production total 280, like we just found, right? We're just jumping off of what we found in this previous problem. And further it says direct labor was $375,000, and manufacturing overhead was $180. And that's the amount that was added to production for the month. Okay? What were the total manufacturing costs incurred for the month? Well, remember, what did we say total manufacturing cost is? That's your direct materials, your direct labor, and your manufacturing overhead. So it's the 280,000, the 375, and then the 180,000. Let's add all of those together and let's see what we get. Do 280 plus 375 plus 180. That gives me $835,000 of total manufacturing costs for the period. That one's simply just an addition problem there. All right, on to the next one here. Okay, for this next one, I just went ahead and copy and pasted since it's a little bit faster that way. So going off of what we found in this previous problem now, we're just building off of that. It says beginning work in process was $125,000. So we can start there. Actually, let's go ahead and make that just a little bit bigger. So beginning work in process, $125,000. It says manufacturing costs added to the production for the month were $835,000. There were $200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? So remember, I start with our beginning work in process and what gets added into this account. We said the manufacturing costs, right? Total manufacturing costs, which we just found in that prior example. So to that we add our manufacturing costs incurred for the period. We add in the $835, and the combination of those two, that is going to give us the total work in process for the period. So 125 plus 835, that should give us 960. But then they tell us, okay, of this total work in process, at the end of the period, there was only $200,000 of it left, meaning we finished a lot of the work, right? So we take our ending work in process, subtract out the $200,000. That leaves us with $760,000 of what? That is how much left the work in process account, right? And what do we refer to that amount as? Whatever work in process is credited for, right? When amounts leave that account, that amount that leaves the account and moves to finished goods is referred to cost of goods manufactured. Because remember, cost of goods manufactured is the cost of the work completed for the period. So here we had total work in process of $960,000 for the period. We finished $760,000 of it, which left us with only $200,000 of work in process left. So the $760,000 of work we finished is called cost of goods manufactured, which moves from work in process into finished goods. So the answer for that one is $760,000. All right, and lastly, here we're talking about finished goods. So building off of what we just did. Beginning finished goods inventory was $130,000. Okay, so we start there. Beginning finished goods. And then it says the cost of goods manufactured for the month was $760,000, which we just found, right? And the ending finished goods inventory was $150,000. What was the cost of goods sold for the month? So we start with the beginning finished goods, and we know the cost of goods manufactured is the amount that gets added into that account, right? Moving from work in process into finished goods, and we know that's $760,000. Well, when we add the 130 and the 760, that gives us 890, I believe. Okay, and the beginning finished goods plus the amount that we add into finished goods is simply the cost of goods available for sale. Okay, but then of that cost of goods available for sale, they're telling us that at the end of the period, there was only $150,000 of finished goods left. So we want to figure out, okay, if we had $890,000 of goods available for sale, but then we ended the period with $150, that must mean we sold some, right? And that amount, the difference there should be cost of goods sold. So $890 minus $150, that should be, $740,000 there. Okay, for our cost of goods sold amount. Okay, so for the quick checks 1 through 4A, looks like, or just, 1 through 4 in the PowerPoint, it's all these problems. Those are really good problems to go over and make sure the way that we're writing it out this way, that's why we want to be doing these problems, and make sure you understand that flow of costs and what makes these accounts increase and what makes them overall decrease. And we'll finish off this discussion by talking about under and over applied overhead and how to prepare the journal entries to close out the manufacturing overhead account, right? So for this one, we're just going to be talking about under and over applied overhead. So under / over applied overhead. So recall that when we're looking at the manufacturing overhead account, when we debit this account, that refers to actual manufacturing overhead costs, right? We keep on debiting this account throughout the period as we know what some of these actual costs are. But we won't know the total actual amount until the very end. But as we go through that period as well, we're working on jobs, finishing jobs, and as we work on jobs, we're applying overhead to them. And this is when we apply overhead to a job, we credit manufacturing overhead and debit work in process at the same time. But naturally, because this applied number involves estimates, we're probably going to not cancel out here. We're going to have some kind of balance left over. Our debits aren't going to equal our credits, and we're going to have a number left over. So that is going to lead to either under or over applied overhead. So if there is under applied overhead present, that means that the number you have on the right here, whatever you debited the account for, is less than what the actual costs ended up being, whatever you overall debited the account for. So if there's overall underapplied overhead, where is your balance going to lie? Because remember, let's say your actual will represent that with 2 x's. We said underapplied overhead means you didn't apply enough, right? Where is your balance going to lie then if you have underapplied overhead? It's going to be on the debit side here for manufacturing overhead. Okay, so when there's underapplied overhead that exists, when the amount of overhead applied to jobs during the period using that POR is less than the actual amount of overhead that we incurred. Okay, so that means we probably just kind of undershot or underestimated when estimating total overhead costs and estimating allocation based, so on and so forth. Never will these two numbers ever really be exact. It's almost impossible, right? Because we're using estimates to apply overhead. But we want to get them as close as possible, right? So, but the presence of underapplied overhead just means we kind of a little bit undershot the applied figure there. But then what about overapplied overhead? That must mean the opposite, right? Well, if overhead's overapplied, remember the left-hand side's the actual, the debit side's the actual side, credit or right side's the applied side. If we overapply overhead, where is the balance going to lie? Well, that means you applied more overhead than what you actually incurred. Where will that balance lie then? It'll be on the credit side instead. So overapplied overhead results in a credit balance in the manufacturing overhead account, where underapplied overhead results in a debit balance in the manufacturing overhead account. Okay, so overapplied overhead again results when the amount of overhead you apply using the POR is more than what you actually incurred. Okay, so we'll look at an example here. Okay, so let's take a look at this parent company example based on what we just talked about. So it says parent company's actual overhead for the year was $650 with a total of 170,000 direct labor hours worked on jobs. Parent company's predetermined overhead rate is $4 per direct labor hour. So they give us the actual overhead, but we want to also know what our applied overhead is. So remember, to apply overhead, you multiply the POR by the actual amount of the allocation base or activity. So here they give us the POR. We didn't have to solve for that. So for them, it's $4 per direct labor hour. And how many hours did they actually work on the jobs? They said 170,000 direct labor hours. So let's figure out what that is. We'll do 170,000 direct labor hours times 4. That gives me $680,000 of applied overhead. So we want to be able to figure out how much was it over or under applied. Well, for that, we simply go to the T account for manufacturing overhead. Remember, the debit side is the actual side, right? That's where we're going to put the actual overhead of $650. But the applied side was the right side, and we ended up applying $680,000 manufacturing overhead. Are we under or over applied here? Because remember, actual side, applied side. Okay? Are we under or over applied? Well, it looks like our applied overhead is more than our actual overhead. So that must mean that we have over applied overhead. And how would I know that? Well, the debits don't equal the credits. I have a debit balance here of credit balance, because our credits are more than our debits, my bad. The $650 being subtracted from the $680 gives me a balance of $30,000 on the credit side, right? Because our overhead is over applied. The $650 or the $680 cancels out all of the $650 and still leaves me with $30,000 on that credit side. So my overhead in that case is over-applied. So now that we know that overhead is over-applied in the amount of $30,000, now when we look at that manufacturing overhead account, it's just sitting there with a balance of $30,000. So what do we do with that? Okay, there's two ways that we can deal with that over-applied overhead amount. So one, we can close it to the cost of goods sold account, or two, we close it proportionately to work in process, finished goods, and cost of goods sold based on what those balances are at the end of the period. Okay, so we're going to mostly be focusing on the first method. It tends to be the most straightforward, where the second method is a little bit more complex, so it's going to give you a little bit more accurate distribution of that over-applied amount, but the first one obviously is going to be quicker. So let's see what that would look like if we're going to close it to cost of goods sold. So just like we would close our revenues, expenses, and dividends and income summary in financial accounting, the same concept applies here. I want to close manufacturing overhead. Now it's sitting with a credit balance of $30,000, but I don't want anything in that account. I want to close it using method 1. I want to close it to cost of goods sold. So how do I zero out the manufacturing overhead account? I debit the account. I debit the manufacturing overhead account. So if I debit something over here, I need to credit something somewhere else, and that somewhere else is under cost of goods sold. So I've credited cost of goods sold here, and by crediting cost of goods sold, I've just decreased cost of goods sold. And if I decrease cost of goods sold, I'm increasing my net income. So by fixing that error, I've adjusted net income and cost of goods sold to where it needs to be. And remember here, the overhead was over-applied. That means I put too much cost under manufacturing overhead, right? When I applied it, too much cost, right? And keep in mind, as you apply manufacturing overhead, you add it to work in process, and as you finish those jobs in work in process, it moves to finished goods, and as you sell the finished goods, that moves to cost of goods sold, right? So that too much cost, right? That over-applied cost of manufacturing overhead that gets put into work in process flows all the way through to cost of goods sold until we fix it. So we're kind of proactively fixing this mistake using method 1 by saying, okay, although I might not have sold the goods yet that are responsible for the cost in question, I'm going to go ahead and decrease cost of goods sold now with this entry to fix that mistake. So although it was initially thrown into work in process, okay, I'm going to just go ahead and decrease cost of goods sold by skipping a couple steps. Now the second step, instead of just doing the overall decrease to the cost of goods sold, the entry to close the manufacturing overhead account is proportionately added to or taken away from those 3 accounts. But let's see what the first method looks like in journal entry form for this. Remember, we debited manufacturing overhead and then credited cost of goods sold. So it simply just looked like this: a debit to manufacturing overhead of $30,000, and then a credit to cost of goods sold for $30,000. So that's what it would look like in journal entry form. The only difference then, like I said, for the entry for method 2 is instead of crediting cost of goods sold, you would credit work in process, finished goods, and cost of goods sold all proportionately based on what balance they had last time they were adjusted.